Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital. And typically joining me would be the smartest guy in the room, Mr. Michael Becker, but he is on another due diligence assignment, looking at another transaction good for him and his team over at SPI. So joining us today is the professor himself, James Eng. James, how are you?
Good. Thanks for having me, Paul.
So this is my favorite podcast that we do on a quarterly basis. We bring some of the Old Capital loan officers in. As you know, Old Capital is a commercial real estate debt provider throughout the nation. And I think we're more of educators than we are of providers of debt. I mean, we do, $1 billion plus in apartment loans throughout the nation. But I think what our passion lies with really educating people and making sure that they're making the right decisions, because we don't want to see anybody lose any money. So we go in a little bit more detail as educators about how the system itself works. And so we pull the curtain back. We let you kind of sit, stand, whatever you want to do, be a fly on the wall when we start talking about transactions and how they are truly put together. There's a lot of people that have some information. There's some people that have a lot of information. Then there's a lot of people that have no information how these deals are put together. So our duty, our job, our challenge is to kind of get you up to speed a little bit about what we're seeing in the market and how to put transactions together. So in the podcast today, we have John Brixson, loan officer for Old Capital. John, how are you?
Hey, Paul, doing well.
And Ricardo Hinojosa. Ricardo, how are you?
I'm fantastic.
So I'm going to kick it over to James, and let's kind of just give a kind of a point about where we're at right now. And as we're recording this, we're in kind of the first week of November. And we're trying to kind of understand a little bit about what's going on. Are deals closing? What's the momentum of the market? James, kind of give everybody an idea of what you're seeing out there.
Yeah, I mean, I think it's really on the multifamily side in terms of demand, what we're really seeing, and investors are seeing this, owners are seeing this, is the first thing is absorption, right? So you're seeing Class A properties lease up in 8 months instead of 24 months. On the Class A side, which is driving a huge amount of demand across the spectrum A, B, and C. So you're starting with the absorption. Second thing we're seeing is rent growth is finally, it's like one of those weird things that people talk about. They always forecast rent growth, but we haven't really seen it in 2019 and 2020 as much as this year. So really starting in February, whether you look at REITs or whether you look at Yardi data, I mean, we're seeing 15, 20% lease trade outs on new leases and, 5 to 10% on renewals. And so that rent growth story that people have been waiting for is finally here. And so that is causing pricing to really soar. And, just because you got 1 month of lease trade outs, that doesn't translate, right? So all of our leases aren't turning over in 1 month. It takes, 12, 18 months for these leases to turn over and really see that in the rent roll. So we've seen an acceleration of pricing, an acceleration of investor demand really in the last 2 or 3 months. And on this call, we'll talk about some of the challenges with that, right? Because, Fannie and Freddie are really looking back historically, but bridge lenders are looking forward. And so bridge lenders are even more confident now, I would say, in terms of pro formas. So at the beginning of the year, we were seeing no rent growth and people were performing, 5, 10% rent growth. But now we're actually seeing it in the T12s and the rent rolls here.
John, my question is to you, talk a little bit about if we have these huge rent growths that are coming out right now and have been here for a little bit, do you underwrite these deals at 12, 13% rent growth for next year and the year before after that? I mean, what's realistic? What should people, if they're putting together their Excel report, what are lenders really looking for the next couple of years?
Yeah, Paul, I mean, I think that's the big question is where's rent growth heading for the next few years? And then where are interest rates heading for the next few years? And, I think undoubtedly, you've seen rent growth of 15 to 20% in a lot of markets across the country, including DFW. And I think that's really been kind of a combination of, you've had a lot of people, just household formation, so people who maybe moved in with relatives during COVID. Now COVID is, we're at the light, kind of at the end of the tunnel here, and people are moving back into units. You're seeing population growth, and then just a lot of multifamily owners really didn't move rents at all, or they might have even lowered their rents during COVID. And so there's just all around rent growth for this next year, or at least over the next couple of quarters. A big question is, is there going to be, is it sustainable, and will there be 5 to 10% rent growth in 2023, 2024, 2025? And so I think what I'm seeing, Paul, is people are underwriting, usually a pretty good pop in rents the first 12 months, maybe 5 to 7%. And usually this is backed up by data, with Yardi or with CoStar. And then for the next 2 years, it's usually 3% for year 2 and year 3.
And then James, talk a little bit about, we just touched upon interest rates, and we touched upon, occupancy and the rental renewals going up tremendously. But talk to me about, production right now. Old Capital is just kind of we do a lot of business, but how much of our business is bank loans? How much is it Fannie, Freddie, and how much is it bridge? Can you kind of break that down? Because I think that's important for people to kind of understand about what type of loans are out there right now and which ones are really being used.
Yeah, I would say in 2020, I would say probably about 75% of what we did was agency. So Fannie and Freddie. Number one, because they were the only people in the market. But then number two, they were still, the rates were extremely low. They were in the, high 2s, low 3s. You had to put up a reserve for 12 months. But other than that, you knew that if you signed a loan up with Fannie and Freddie in 2020, they were going to close. It might be a little bit slow, but they were going to close. And then beginning of 2021, at the beginning, we started seeing our mix shift to maybe 30, 40% of what we did was bridge, maybe in the first half of 2021. And then right now, probably for third and fourth quarter of 2021, probably 80% of what we're doing on acquisitions is bridge right now. So only when a deal, I would say deals under 10 million or maybe even under 15 million, where the cost of a bridge loan, whether it's interest rate caps, whether it's legal cost, the cost of the bridge loan was not worth, they would rather just take a Fannie or Freddie loan and set the deal right now. And there was not that big of a leverage difference. And so, 5% or 10% leverage difference on a $10 million deal is very different than a 10% difference on a $30 million deal. And so we're still doing some Fannie Freddie loans out there in terms of Freddie SBL and Fannie, but majority of the book in terms of originations is bridge loans right now.
Ricardo, let's talk a little bit about bridge loans. Let's focus a little bit with you on bridge lending. You do a ton of bridge loans. Tell me a little bit about, what people today, and we're talking about, say, the first week of November here, what can people expect? If someone brought in an opportunity for you to try to close this deal before the end of the year, how long does it take you to stop laughing to try to get that deal done?
That's funny. James and I were just talking the last couple of days around calls that we get. Hey, we've got to close this year, whether it be the buyer or seller is realizing, hey, from a tax perspective, it's beneficial to close this year. Just yesterday, we had a situation where we've got a seller. So this is an off-market transaction, $20 million loan here in DFW, where he's got 3 or 4 buyers that were all pretty much equally priced. And he threw this out there yesterday. If someone can guarantee you close this year, you win the deal. But you've got to have a contract that states, a hard close date at the end of the year with no extensions. So if you don't hit it, your earnest money is totally at risk. No one was willing to take that bet and push forward. So,
why is that? Why can't the bridge lenders, the debt funds, how come they can't close within 35, 40 days? What do you mean? Kind of walk it through in some people's minds who don't do transactions too often.
Sure.
What's the pushback?
So the pushback is there are just so many people involved in that pipeline, right? So usually we need at least 60 days to get a deal done, even with bridge debt. Historically, it's been more like 45 to 60. But with the amount of volume these bridge lenders are seeing right now, and not only the lender, but the third-party inspectors, the attorneys on these bridge loans, most of them we're having to get new surveys. So surveyors, so everybody that touches this deal throughout that supply chain of getting a loan done is backed up right now. So
yeah, so it sounds like supply chain problems like all of us have, huh?
Absolutely. So 60 days, I think is the minimum right now. But then if you're kicking off a deal right now, you've got the holidays to deal with. So if you look at the calendar, you're going to lose a good week for Thanksgiving. This year, Christmas and New Year's fall, I think, a Friday or Saturday. So, you think
I can see why nobody wanted to sign their name and be liable for not be able to close and that seller capture your $300,000. That's not good. John, talk to us a little bit about what are you seeing for terms out there? Because I think today is a different day than it was, say, 6 months ago. And so some people still have in their mind's eye that everything's the same. So give us an idea, really, walk us through what a typical transaction is going to look like on a bridge debt.
Yeah, I mean, I think the biggest change that we've seen in the bridge market more recently is that because these lenders are so busy and their pipelines are so full. I mean, I'm in the market right now with like a $16 million bridge loan, and I've had one of my go-to lenders said we're only doing 20 million and above right now. Another group, has said that they have 60 closings in the next 60 days they have to do by year end. I have another one that said they have 40 loans that are currently in the pipeline that are closing. And so basically what's happened is they've said, really, we're either not doing loans that are 10 million and below, or if we are doing it, a 10 million or below bridge loan, the interest rates are going to be higher. So it used to be, $8-9 million bridge loans were pricing in kind of the mid threes range, even at 80% LTC. And now to kind of pull back a little bit, they've increased their rates from 3.5%, up to as high as 4%, maybe even higher than 4%. So that's kind of the biggest shift that I've seen, is that kind of the 10 million and below has gotten a little bit more expensive. And then, 5 million and below, it's really just, I get a lot of questions and requests on, hey, can I do a bridge loan for, this $4 million acquisition? And, banks almost always I'd recommend are going to be the better option there. But I'd say, Paul, for the larger balance bridge loans, so maybe 15 or even 20 million and higher, still very competitive. We're seeing rates as low as 3% at the 75% leverage range, and then, as low as 3.2 to 3.3% at 80%.
James, any comments on that? What are you seeing out there too?
Yeah, I mean, I think going back to the year-end close stuff, like we were talking before this, I mean, these bridge lenders have been at the buffet for the whole year, and they are just, I'm not saying they won't take the chocolate cake, but usually that last piece of chocolate cake is just they're not going to be able to get out of the restaurant at that point. So they're just out of sort of lending capacity, and they would much rather. So you as a buyer, if you can just, get a deal under contract right now and say, hey, it's going to be a January close, I think you're going to have a lot more flexibility in your debt. So you're going to be able to get better terms, better leverage. Just more people are going to be willing to bid on that. But if you have to close by year end, all of a sudden you better get a discount on price, because your rate is going to be higher. Your leverage might be lower. You might have to take recourse. You might have to go. So most of the deals that we're doing right now, it's sort of your standard non-recourse guys who are 3 to 4%. But if you start going to not necessarily hard money is 9, 10%. But if you start going to sort of these soft hard money bridge lenders on a $5 million, $6 million deal, your interest rate might be 6, 7%. And so you better build that in to your model in terms of, that's what you're going to have to pay if you want to close by this, by year end. So try to get a discount on price if you can.
So again, I think one of the things that I heard is don't be modeling a 3.25%, 3.5% interest rate. Probably be better to model a 4.25% interest rate these days with on the bridge loans.
Under $10 million.
Under $10 million. And that I only learn when I hear case studies and stories. And so, Ricardo, can you walk me through maybe one or two transactions that you're working on? Let's keep the names and the places at risk from being exposed, but let's just talk a little bit about some of the transactions you're doing, and let's just kind of walk through one or two deals.
Yeah, definitely. We spent a lot of time talking bridge loans, but we've been doing some Fannie and Freddie stuff as well. I'm working a deal that we're going to close this week, actually a Fannie Mae floater. So there are deals that still do pencil with Fannie and Freddie, not many, but I'm working two floaters right now, actually, one Fannie, one Freddie. The one that's closing this week, what we're working through right now, so it's a $25 million loan. We're in the final stages of kind of getting the rate cap. So it's a floater at a fantastic rate. So we locked it in at 255 over SOFR. So they're going to have an unbelievably low rate going in, but it's a floater, and Fannie Mae does require a rate cap. So they require a 3-year rate cap. There is flexibility. You can go all the way up to 250, a 250 strike. So for those of you that don't know what that means, it basically says that you have insurance up until SOFR hits 250, and at that point your insurance kicks in, and it would cover your debt service over and above that. Just to give you a feel for how rate caps have moved recently, when we kicked off this deal about 45 days ago, for that 250 strike, it was the cost of the insurance was $50,000. And we priced it again this morning, and it's going to be about $100,000 for the same product. So, we've had a sharp run up over the last 30 days or so. So we're hoping that settles down. But that deal should close on Friday. So again, good leverage. We ended up at 75% leverage with a Fannie Mae loan. This is a core market. This is in Indianapolis. Call it a B- deal. But a good submarket, underwrote well, and we were able to get pretty nice leverage going in with Fannie.
Tell me a little bit about the sponsors. What was their background history? How much cash were they going to put into the deal? And tell us a little bit about pulling the
yeah, definitely
carpet back there.
So this is an experienced group, right? This is a 250 unit deal. So experienced group that does have experience in that submarket. So they had plenty of net worth, liquidity, experience, checked all the boxes with Fannie Mae. They're bringing in a good amount of equity. I think overall amongst the KP team, they're at about 10% of the equity, which is substantial for a Fannie Mae loan. They're raising the rest, but all around fantastic sponsorship group. This will be our third loan for them, and they do great work.
Ricardo, what was the loan amount on that again?
$25 million.
So I think, and I did this analysis for one of the clients, is like, I understand the interest rate cap costs have gone up, but one of the things that I would consider is it's almost like paying your prepayment penalty like right now, right? So $100,000 or $200,000 on a $25 million loan, that's less than 1%. So if you said, all right, you can go out, buy a rate cap right now at 2% or 1%, whatever it is. And then, all right, instead of a 1% exit, you have a 2% exit. Would you take that deal today versus paying a yield maintenance in year 4 or year 5 or year 3 on a 10-year loan?
Absolutely.
And every single person.
Which could be millions of dollars.
Which could be 10 or 15% of the loan amount. And so I think, yes, interest rate caps have come up, but I think if you model that out, I think you will see the benefit of that interest rate cap. And I still think there's a little room there. So,
but the overall spreads, and 255, we locked this yesterday. So 255 over SOFR, fantastic grade. Freddie is a little higher. So I'm doing a similar size loan in DFW, size as well. So we're going in, the leverage is a little lower. We're at about 70% on this one. You're going to be, 260 to 270 over SOFR with the Freddie Mac product.
Talk about the difference. Talk about the difference between the two processes, though.
Yeah, so there's a big difference. And it's really that with Fannie Mae, kind of we and the lender control the process from beginning to end. With Freddie Mac, the deal has got to go into Freddie up front, and then on the back end, the lender does their underwriting up front, and then Freddie Mac has kind of the final say at the end of the deal. So it's kind of a two-step process. So we like to have as much control as possible for us and for our clients throughout the deal. So everything being equal, I would do Fannie Mae all day if everything else was equal, just because of that level of control and our ability to influence the deal.
Yeah. And so the Fannie floater starts at 15 million right now. And then the Freddie floater starts at 7.5. So if you're in that in-between space, you might have to go Freddie. And then we've seen some people who they just have a relationship with Fannie historically, or they have a relationship with Freddie and they want to continue that. And so that helps as well. So that might determine which way you go on the floater.
John, tell us a little bit about, we get all kinds of questions because I don't want to put any money into this deal, but I want to sign as a GP. And, how about if I put $15,000 into this $15 million deal? Does that work these days with Fannie and Freddie? And also the bridge loans? What are you seeing when you talk with clients that don't want to put a lot of money into these transactions up front?
Well, I think, maybe Ricardo can talk about the Fannie and Freddie requirements in terms of what they're requiring more recently for minimum investment, because, right now I can't really convince my borrowers to take a Fannie or Freddie loan, even if it underwrites for Fannie or Freddie. It was, I was talking about this yesterday with somebody, but, 2 years ago, I really nobody wanted to do bridge. And I couldn't even really persuade people to do bridge unless it was a really compelling deal. Everyone wanted to finance with Fannie or Freddie. And if it didn't work with Fannie or Freddie, they really wouldn't even put an offer on the deal. And now it's, even if something underwrites for Fannie or Freddie, I had a loan, about a $22 million loan that we signed up last week where it underwrote for Freddie, and for Fannie and Freddie. We were getting just below 75%, 5 years of IO on a Freddie floater, with like a 2.65% rate. We were getting at 75% with, I think, 3 years of IO on the 7-year floater. But we had a bridge option that was at 80% and like a 3.3 or 3.4% rate. And they ended up taking that. And so anyway, to answer your question, Paul, in terms of minimum investment, and I'd be curious to hear what you guys are seeing from the Fannie and Freddie side, but a lot of these bridge lenders and pretty much all bridge lenders, one of their big hot buttons is they want to see a minimum investment from the group of key principals or the key principal that's signing on the loan. So they usually want to see, at least 5% net of the acquisition fees invested into the deal from the key principals. So, if you're buying a $10 million property and you have a 1% acquisition fee, so let's say it's a $100,000 acquisition fee. If your total equity raise is $2 million, they would want all of the guarantors to invest that $100,000 acquisition fee plus that 10% of that total equity raise. So if your raise is $2 million, they'd want you to put in $200,000, which is 10% of $2 million plus that $100,000. And this has been something that, I think a lot of key principals will kind of overlook, and something that I always point to before we have a signed loan application that, hey, just be prepared. We were at 10% when we first came out with this loan application. We've negotiated it down to 5%, but this is how much you'll be expected to invest at closing, and be ready to write that check. And so I think, historically, my understanding is Fannie and Freddie were a little bit more lenient, or maybe didn't dig in quite as much on this specific requirement with minimum investment requirements. I'm not sure if that's still the case, but with bridge lenders, it's definitely a little different. That's a big hot button for them, and just making sure that their borrower has skin in the game.
Ricardo, what's your 2 cents?
Yeah, so John's right on. So Fannie and Freddie are more lenient. They haven't really changed much recently. I think if their biggest thing is experience and the relationship you have with Fannie and Freddie. So there's not a kind of a line in the sand that you've got to have 5 or 10%. I would say if, as a KP team, if you're below 5, then that, we might start asking some questions. But at the end of the day, they're going to want some skin in the game, but it's not as, cut and dry as it is with the bridge lenders.
Yeah. So on the bridge side, I mean, guys are checking, the lender's underwriter is checking your Exhibit A of your operating agreement.
Oh, yeah.
All the way down to the penny and saying, all right, you've got $2 million in equity. Where's the KPs? What's the acquisition fee? They're doing the math. This is like the day before closing. So you better make sure you have the money in there. And then another thing that I would mention that's a little different compared to Fannie Freddie is a lot of these net worth and liquidity requirements. It's not only at close, is some of these bridge lenders have that net worth and liquidity requirement throughout the loan. So you can't just show up with liquidity of 10% of the loan amount at close and then a year from now go spend all the money. They want it throughout that process, because you have to remember on these bridge loans, you're taking a property, you're putting in a significant amount of CapEx, which might mean your occupancy is going to drop, your cash flow might not be as great. So they want these key principles on these deals to have a little bit of money set aside, at least 10% of the loan amount typically. So they're going to check that liquidity. And if your guarantor group sends in their balance sheets, let's say a year from now, after the bridge loan closes, and you don't meet those requirements, that could be a trigger on that lockbox that you thought you would never trigger.
Yeah, absolutely true there, James. I would also throw my 2 cents in, is that if you were to go to a bank, a bank is going to require you to put in, not in 5% or 10% as a group. They would typically want you to put 25, 30, 40% of your own equity into these deals. It's the debt funds in Fannie and Freddie that will require you to put less into these transactions. But so they got to hang their hat on something. And one is experience. And so again, they want you to have experience. And experience really means is that not only did you sign as a KP or general partner in the deal, but also Tuesday, you were part of the controlling membership of the manager of the entity that manages the entity itself. So they're going to go into figure out at what level did you bring in your experience and you sign on the deal. Other part is that if you don't have experience and you're trying to go into some of these markets, they want you to put some significant cash into the business. And I'm talking about Fannie Mae and Freddie Mac. So they could require, if you have lack of experience, they could require you to put 5, 10, 15, 20% down into the transaction itself, because again, this is a non-recourse loan. So they can't go back and just hold the collateral part of the deal. They have to figure out exactly how you are going to be able to keep this property going in case of a rainy day. So John, talk a little bit about 1 or 2 transactions that you're working on that you think is pretty interesting.
Yeah, I mean, I think James mentioned earlier closing in January or in 2022 instead of closing by year end. And I'm currently in the market with a bridge loan request, and borrower really wanted to close by year end. And I think there are some lenders that are interested in closing by year end, but yesterday I had a conversation with him, just how important is it to close by year end? And he said, well, if I can really get better terms, if I close in 22, then, I'm open to closing in 22. And so, we had a few lenders that said, if it's a year end closing, then we're passing. But basically what I told him is that, if you do close in 22, you'll have a lot more groups that are quoting it, which means you'll have more competition, which means you'll ultimately have better terms. And so we ended up moving that into 2022. But, overall, I'd say, a lot of these bridge loans, it's more important than ever to really move pretty quickly and have your ducks in a row from the very beginning, as much as you can. I think as soon as you have an accepted LOI, we should be reviewing the underwriting, reviewing your pro forma, putting together our presentation and package for lenders. And then ideally, as soon as you have an accepted, or as soon as you're under contract and have a signed PSA, you're doing your unit walks, you're doing your physical due diligence. And then as soon as that is done and your CapEx budget is ready, your business plan is a little bit more concrete at that point, we can put the finishing touches on our presentation and get out to bridge lenders, because it's just taking people more time to review loan requests in the front end. There's a lot more kind of back and forth with lenders as we're negotiating a loan application, negotiating what is that minimum investment between the guarantor group, for instance. And then once we have the signed loan application, there's a lot of different parties that are involved that are also very busy. It's the lender legal, borrower legal, the underwriting team with the lender. The lenders have their warehouse lenders who are also underwriting these loans. So there's a lot of moving pieces. And I think the most important thing I'd probably emphasize right now is just timing and having the timing down and making sure you have everything together. And I think one thing I would, just an observation that I've had, and I don't know if you guys are seeing the same thing, but I feel like I'm seeing more deals that are falling out of contract this year because I think people are paying really big prices and they're reaching, and then they're going out and maybe they fell behind on their bridge loan and they haven't gotten the bridge terms they expected it to get, or their equity raise isn't coming in as strong as they thought it would. So I guess I'd be interested in hearing your thoughts on if you're seeing more deals fall out of contract or people extending longer, or, any of that.
I've seen more extensions. I think depending on the deal, depending on the sponsorship, the equity is still there, especially at year end. So a lot of these people who are going out raising money right now, they're almost guaranteeing. I mean, we're not attorneys on this call, but if I'm a sponsor, I would not guarantee a 2021 close, because sometimes that's what's getting the money in the door is the depreciation piece here in November and December. So I would just watch that. But most of these sellers, if there's hard money and the guy's going to close, they're just extending. I guess you're saying the buyer's just given up, like they're too far away from their equity and they're just walking. Yeah.
And I mean, part of the reason I'm saying this is I'm involved in a deal right now where my borrower is selling a property and they're going to 1031 into the property that we're financing. And so the property he's selling, this group that's buying it, they're out-of-state group, and they have one or two other properties in DFW. They're paying a big number for this property he's selling, and they keep extending. And, finally he's getting to a point where he's just like, I'm done with these guys. And, we can't keep extending on this property that we're buying because the seller of this property, they want to close eventually. And he knows that my borrower is good for the money and that he's going to close, but that he says, I can't just keep waiting for your 1031. And so, I think this group, ultimately, I think he's just going to take the earnest money and walk away. But something else too, I think that's also interesting that I've heard about is, there is hard money, but if your money is hard and it's sitting in escrow, and if you're the buyer and you don't perform and you don't close in the property and it falls out of contract, well, the money's still sitting in escrow. It's not sitting with the seller. And so a lot of times these buyers are going and disputing the hard money, basically saying that there is a seller default here, so I should get my earnest money back. And so it might be quote unquote hard, but the seller knows that I can sit here and I can fight the buyer for the earnest money and drag this into court, or we can just settle, maybe split 50-50. So I just feel like maybe it's kind of on the smaller, the smaller deals, like sub $10 million deals. I'm seeing more stuff kind of fall out of contract, but I feel like it's become more and more common this year.
You as a buyer, that's not like something you want to do on a listed deal with a big brokerage and like just completely dig up the deal.
Definitely not.
Because the chance of you getting awarded the next deal decreases dramatically if you do that.
Let's talk a little bit about the potpourri, just subjects that have nothing to do with transactions itself, but you think is important for people to know about what's going on. John, I'll have you kick it off. Who are you reading right now that gives you kind of an idea where interest rates are and where the economy is going? Anything that you could throw out to people that are listening to this that you find to be interesting?
I mean, I'm really just kind of reading the regular, Wall Street Journal and Bloomberg, but, one weekly newsletter that I get that I think the rest of us also get. And we had JP on our podcast a few weeks ago, but the Pensford letter from, JP Conklin, I think is a pretty interesting read. And he actually had a pretty interesting letter this week about the rising, why cap costs are spiking. So that's what I'd recommend, or that's what I read.
And Ricardo, not so much on that topic, but what do you think people should know about what's going on with financing these days?
The one thing I would add, as John was mentioning, with deals falling out or extensions, I haven't had a lot of deals fall out, but the extensions seem to be the norm right now. And
just to be clear, I haven't had any deals fall out. I'm
no, in terms of buyers
this year, but
Gotcha.
I've heard about I've had I guess clients that have sold properties that have had some poor behaving buyer groups. Yeah,
gotcha. But in terms of kind of thorns in my side right now, one of them is on these smaller deals, because I'm doing a handful of Freddie SBL deals, and this whole Texas rent relief on small deals. And I'm not seeing it a lot on large deals. So if you have a 200 unit deal and you might have 4 or 5 folks on Texas rent relief, on a B class asset, that seems to be normal. But I'm seeing like on a 20 unit deal where, if let's say it's a Freddie SBL loan, Freddie Mac is spending a lot of time not only on the rent roll and the T12 like they always have, but they're really digging into delinquency reports. And a property that might be a 20 unit deal that might have 3 or 4 folks on Texas rent relief, if they see that and we see that, the way Freddie is approaching it is, if even if you have been approved for Texas rent relief, but if they're 2 months behind, a lot of times what they're doing is they're counting those as vacant units. So they're not giving you credit for it because you're not collecting it. So they're seeing that as a tenant that can't pay rent. So just to watch out, especially on the smaller deals, pay attention to the rent roll and collections. It's not just a T12 and a rent roll. It's what are they actually collecting?
And how about the charge-offs that you usually get on a sale? Talk a little bit about that, because I just got hit with that this week on a smaller deal where the group was selling it. All of a sudden decide, hey, listen, I need to take this right off all this rent that I couldn't collect. I'm going to put it in here for August or September, which was $9,500 that they couldn't collect for the whole year. And they took the 1 month to write it off right before we were to close. What type of impact does that have, James?
Big impact. So there's, Fannie, if it's a Fannie and Freddie loan, they're going to be really looking at T3 if it's going up. But if your collections are going down, so your net rental is a combination of your collections, but then also they're going to, decrease it for concessions and decrease it for vacancy and bad debt. So if you take a big bad debt and you had collections of, let's say, 100,000 leading up to closing, and then, Fannie does one last check. Let's do one last check. Send me the T12, let's say for September, and we see an 80,000 in there. Fannie that's going to trigger declining collections, and then all of a sudden they're going to do a T1 on 80,000 instead of 100,000. And that will pretty much kill your loan amount right there, because that's going to drop your NOI significantly. So yes, on Fannie and Freddie, I would watch that. On bridge lenders, I would say they're looking at year 3. So today's NOI or net rental is not going to matter as much, but on Fannie and Freddie, it will. The point that I wanted to bring up, and, John was talking about this a little bit earlier on a deal where, we're going out to these bridge lenders. And I think the amount of work that goes into presenting these deals to all these different bridge lenders and how we present the deal is even more important now when bridge lenders are full. So bridge lenders are getting packages from everybody, but they're really going to focus the same way Fannie and Freddie are going to focus on sponsors that they've done business with. They're going to focus on mortgage brokers that they've done business with. So we're going to lenders that we've closed with, that we know that are going to provide good terms, and they're going to show up at closing. So I think that's a huge point. Some people are like, well, the bridge lender is charging me 1%. Why do I have to pay you guys anything? Right. So I think on the front end of these deals, we're going in, underwriting the deal, making sure that you're presenting the deal correctly, and then, competing these bridge lenders against one another to make sure you get the best loan terms. And so a lot of times we might be working on a deal for 30 days or even 45 days before you even sign a loan app. So a lot of the work is upfront on these deals to make sure that you're presenting it correctly to these different bridge lenders.
Well, and the other thing too, I'd point out, James, is, I've sat in those bridge lenders seat before, and, I covered, I was, basically an analyst or associate, kind of a junior guy that was working with originators, across the country. And we were getting loan packages, and we sourced 100% of our business pretty much was sourced through mortgage brokers. And so we got requests from all different types of brokers all across the country. And, the brokers that would present kind of a clear, concise business plan and strategy and presentation, like those went to kind of the top of the pile. And the people who, kind of sent in a half-baked or not like a full package, or I kind of had to piece everything together, those kind of went to the bottom of the pile. So it's never been more important to work with someone too that also, can present your deal in the best light, because people are more busy than ever.
James, that's probably a good opening about working for people that know how to create the story, and talk a little bit about maybe an opportunity at Old Capital.
Yeah, I mean, I think we try to bring on like one person a year. And so, we're looking for someone to join our team here in 2022. Whether you have a background, almost all of us had some sort of, it was either a lending background or an investment background into the multifamily space. And so I think that, just the amount of business that we've had, we're always looking for new talent and people to come in to the organization. So that is one thing. If you have made it this far on a lending roundtable on Old Capital podcast, then you probably are a candidate. So definitely reach out. Probably the best way is via email. So you can send me an email at jeng@oldcapitallending.com, and I can provide more details there.
Sounds good. Let's just kind of go around the table to finish off here. Ricardo, any words of wisdom for anybody that is looking to buy an apartment building these days? You think the water is still good? Good time to go swimming in the investment world?
Yeah, absolutely. I think just to reiterate some of the messages from earlier, I think make sure you've got your business plan up front and you engage us early. You kind of know where you're taking the property. It's not easy to find a deal. Deals are obviously expensive, but there are deals to be had. Deals do underwrite. And if you have a good business plan, it's definitely doable.
John?
Yeah, I would just say as more and more people are doing bridge loans, I think the operational side becomes more and more important. And, just being able to execute on your business plan and getting the rent increases that you were projecting, running your operating expenses, at kind of the levels that you were projecting. And, I think if you have been able to execute on your business plan, you should definitely, as soon as you've stabilized the property, you should start thinking about, should I refi or should I sell? And I've been helping borrowers out with that analysis, looking at what's their partnership, what does their promote look like? Here's a BOV that we have from CBRE or Marcus & Millichap, and here's the price we could sell it at, versus what would my loan proceeds be if I do a cash out refi, and what would that look like? So I think, as soon as you have executed on your business plan, look to lock in, I think long-term fixed rate debt or a floater, or look at selling.
And James, the professor, Eng, last words always for you. And then can you brag a little bit about your video that you just came out with about 2 weeks ago that I think people would want to watch and understand a little bit more? And you go into great detail on some great subjects. Can you talk a little bit about that and then have the final word?
Yeah, I mean, I think there's definitely deals to be had out there. I mean, the investment market, we put some slides together last week about just the number of people coming to Texas instead of just driving the investor demand. And so, everybody's concerned about rising interest rates, potentially rising cap rates, but the rent growth is here. And so that should cure a lot of these items. And then, the market thing that I mentioned, our market report that we went through, I think is a good one to watch on YouTube, and just in terms of what other operators are seeing in their book as well. And so I think those are the main things on my side. So
I'll put the link for James's YouTube video in the show notes, so you can download that whenever you have a second. But some great information, guys. We certainly do appreciate the the comments about what's going on in the market. I know that the listeners who are actively investing in multifamily properties, they certainly do appreciate your kind and your very informative words about what's going on. So Ricardo Hinojosa, thank you, John Brixton. Thank you, James, the Professor Eng. Always a pleasure. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.